That's the catastrophic risk that I get concerned about. Welcome to another episode of Real Personal Finance, and this is our second episode about open enrollment season, which is probably coming up very shortly after you hear this episode for the first time. We dedicated our first episode pretty much 100% to health insurance because that simply is the most financially influential choice you can make in open enrollment. But there are a short list of other very influential, financially influential choices you can make in your benefits, and then a whole raft of things that probably don't move the needle very much. So let's talk about sort of that short list of other very influential things, which I think include life insurance choice, long-term disability, short-term disability also, so disability insurance in general. And then, although this usually isn't tied necessarily to open enrollment, your participation in your company's 401k.
Yeah, they're all great things to touch on, some of which you have to make choices during your enrollment, of course. And also good to note that when there's also life-changing events that can allow you to look at your employee benefits as well. So if you get married, for instance, if you have a child. Like there's a number of reasons, and HR will know what they are, to whether or not you're eligible to make changes. So it doesn't necessarily have to be during open enrollment. But yeah, I would agree those are all worth looking at. Which one do you want to start with first?
Yeah. Let's start with life insurance. How do you usually advise your clients on getting life insurance through their employer?
I typically advise, most of our clients, that what I've seen from most of our clients is that they are not going to be at one company for the rest of their lives. They're going to go all over the place. And so we typically advise them to get term life insurance, level meaning the premium doesn't change, term meaning a specific number of years, and then life insurance. We have a dollar amount that's covering our life. It could easily be called death insurance. If I die, someone gets paid who's named as a beneficiary. We typically have them get that outside of their employer. So when it comes to life insurance within their employer, we will typically just have them take whatever the standard is and not get anything in addition. Reason being that it doesn't cost dramatically less when you compare the prices of private insurance, which I was describing earlier, or insurance provided through the employer, right? And it keeps it cleaner. It's like if Meg, if you're our client and you get life insurance, privately held life insurance, you could go from Microsoft to Apple to Google, and you never have to worry about how much do I have again? Do I have the right amount? It's like, no, it's already over there. It's good. You're paying it. We'll take whatever number of times of salary they're offering for free as employee benefit. But we're not going to choose to get extra. Where we will choose to get extra is when someone has trouble with underwriting medically through the private market. So if it could have been that you had maybe a mental health issue in the past. And I'm not knocking people. It's just these are the things that you'll get. The life insurance will come back to you and say, we just can't underwrite you.
Oh, right. If I were to go look for life insurance right now, I would have a very hard time being underwritten.
Breast cancer survivor, like they're just like, sorry, you don't get life insurance. So in that instance, we want to go back to the employer insurance, and we want to see what's the max amount we can get without underwriting. And that's what we want to go get there. So that's what we typically say. Do you do it any differently?
No, very similar. I just had two sort of details to add to that. That one of the nice things about having a private policy that is not tied to your employer is, think about if you've ever been laid off, how stressful that is to lose your job and your income. The last thing you want is to also have to think, oh my God, I just lost my life insurance and I've got 2 little kids or a stay-at-home spouse. So now I've got to scramble to get a new job, not only for like income, but to get life insurance also. So it's just such a stress reliever to know that if you have private insurance, the only thing you need to do to keep that insurance is just keep paying the premium. There's no other thing you need to do. It's not tied to your job.
And to add to that point briefly,
Yeah.
most employer life insurance actually is what's called portable. Like you
Mhm.
can typically move it. But to your point, like you just got laid off and you don't, that's not something that's going to be in your normal checklist, right? So
Yeah.
way better, as you're saying, to have it off to the side.
And that also to your point about if you have like a medical history that's just going to make it hard for you to get private coverage, not only is employer provided life insurance maybe good for you, but if your spouse has trouble
Mm-hmm.
getting underwritten,
Yep.
oftentimes employers will allow you to buy up some spousal life insurance. And
Yes.
we have a couple of clients who have done that because one member of the married couple has sort of a negative health history.
Mm-hmm.
And so they can cobble together some insurance from their own employer and also more insurance from their spouse's employer. And it probably doesn't get them to where we'd like to have them, but it's the best we can do because they literally just can't get private life insurance.
Let's go to disability insurance. So
Mm-hmm.
disability insurance, there's two types we commonly see: long-term disability insurance and short-term disability insurance.
Yeah, and to be honest, I give pretty short shrift to short term disability insurance because
Mm-hmm.
when I think of why do we need insurance, it's to protect ourselves against catastrophic risk,
Mm-hmm.
right? Short term disability insurance replaces your income for 90 days, 180 days. Sure. I mean, for some people, if you don't have $400 in your bank account, that not having income for 90 or 180 days would be catastrophic. Most of the clients we work with, though, have enough cash and certainly beyond that sort of investment accounts that they'd have money to live on if they couldn't work and earn income for 90 or 180 days.
Yeah.
It's that disability that prevents you from working and earning income for years.
Yeah.
That's the catastrophic risk that I get concerned about. And I will say, I usually sort of go into this pitch unbidden from clients with clients because most of our clients are in their 30s and 40s
Mm-hmm.
and they work at computers, and I assume that there's sort of this instinctive assumption of, well, what kind of disability, like if I break my leg or break my back, I can actually still do my
Mm-hmm.
job. And the best example I have is actually from a friend who was a Salesforce consultant. So she was, I think she was like 1099, right? So she
Mm-hmm.
wasn't an employee. She was
Mm-hmm.
self-employed, making good money. She was like 41 years old. She got pneumonia and they got this freak side effect in which she had a stroke. An
Oh my
otherwise
gosh.
healthy person who had a stroke at the age of 41,
Oh.
right? And that's, I mean, we're knowledge workers, right? So anything
Mm-hmm.
that affects your brain's ability to think is
Mm-hmm.
absolutely going to destroy your ability to earn money. Thankfully, she recovered, but that was a very scary
She had to
time.
go through the recovery, and she didn't have
Yes,
income while she did that, which is
yeah,
why we have long-term disability insurance.
yeah. So that is, like, even though we work at computers and we're quote unquote knowledge workers,
Mm-hmm.
we are absolutely still at risk for getting a disability that would eliminate or vastly reduce our ability to do our jobs.
Yeah. Just to add a like, really good example, it's absolutely something you want to have. It's usually a benefit that's just given,
Mm-hmm.
long-term disability. One thing that is interesting to look at, more and more companies are doing this, where you'll look at your pay stub,
Mm-hmm.
and you'll see that you're actually getting paid slightly more than the cost of the annual premium or monthly premium, and then you're paying it after tax yourself. And
Mm-hmm.
the reason why for you guys at home is because when you pay an insurance premium or an insurance contract, if you pay it with after tax dollars, when you get the benefit is not taxed.
Right.
But if instead you pay it with pre-tax dollars, then when you get the benefit is taxed. And you're usually going to see that you're going to get up to 60% of some formula, whether that's your salary or your salary and bonus. RSUs are typically not included, just to be clear.
Correct.
But so it's going to say, hey, we're going to give you 60% of your pay. Now just think about that. It's like most people, like in California, are in a fairly high federal bracket and a 10% California bracket. So you
Mm-hmm.
probably have about, and then FICA taxes, you probably have about 40% of your money going away to
Mm-hmm.
various places. So 60% net pay, that's actually really good. Like you could probably live on that. But it's just something to be mindful of. It's just to look at it and see, like, is this coming to me before tax or after tax? Because there
Right.
could be a big discrepancy there if it's pre-tax. And I have
Right.
seen
Yeah.
it that way too.
Right. And we advise our clients on that too, that if you are able to pay for your workplace long-term disability policy yourself,
Yeah, do it.
it's almost always
Yeah.
a better choice, because when would you rather be subject to this sort of onerous tax bill? Now, when you're working and making hundreds of thousands of dollars a year, or later when you're disabled and scared about whether you'll ever be able to earn money
Exactly.
again.
The other thing I was thinking about was just the weird, because you mentioned short-term disability and you mentioned like 90 days, 180 days. And there's a reason those things exist, just for the listeners at home. Long-term disability normally, and it'll say on your employee benefits when it will kick in, and it's normally 90 days after your disability is declared, which is by a physician. So it's not just that it happened, but it's that the proper, paperwork and hoops have been jumped through to start running a clock, or 180 days, right? And so that's why short-term disability was created, was for people, to Meg's point, who don't have $400 in their checking account, and they need to get paid during that period of time. So if you have a good, emergency fund at home, and you have excess cash coming in every month, and you have RSUs that you could peel off, or you have an investment account, we're almost always going to tell you not to do short-term disability.
Well, not to pay extra for it.
Just not to sign up for it. Exactly. Because it's usually a choice. It's usually a voluntary choice. I guess I was trying. I don't think I've run into a company where it was just given automatically, but I'm sure it exists somewhere.
Well, for example, in California, I think there's a state program where
At SDI, which you have to pay into a tax system
right.
for. Yes.
Exactly.
Yes, that's true.
As we discussed with life insurance, we were discussing sort of the workplace provided life insurance versus getting your own life insurance. I'm sure you do as I do. We evaluate whether or not clients need private long-term disability insurance also.
Yes, which was the next place to go, because
Yes.
what often will happen is like you're living a lifestyle with salary and bonus and RSUs that's way above what 60% disability is for your salary. Right. So you really do need to pay, and paying there is, unlike life insurance, this is a hefty premium, because the likelihood of a disability, to Meg's point with her friend, is actually really high for most of us. The chance of us getting a disability in our lives is far greater than the chance of us passing away when we're young.
Yeah. Yeah. I think I've heard the statistics that, 1 in 4 people will develop a disability that keeps them out of the workplace for some meaningful amount of time.
Yeah.
That's a huge risk to insurance companies. And so they need to receive a lot of premiums from us in order to, still be able to make a profit.
Like you mentioned, I think it was in the last episode, about what you pay for as a family of 4, like for the employees to realize, like for life insurance, for health insurance, right?
Yes.
And I was thinking the same thing, because I think ours is like in the low 20s, 20,000 a year, because we're, we're entrepreneurs and we have to pay out all of it out of pocket for ourselves versus an employer paying part of it. But my next highest bill by far is disability insurance for my family, because I have to protect the income of our family.
Yep.
And I'm the big breadwinner of our family, right?
Yeah.
So we have to go privately to get disability insurance. And I go through a trade group. So like we're a part of a
Professional
financial planning association. And so they have deals with disability companies. And the same thing will happen in the medical profession. There's like through the AMA and through various, and sometimes even through schools. I'm sure that I can't say I've ever researched this, because I haven't looked that deeply at if there's any trade associations in like tech and biotech.
I've never
I'm guessing you're
encountered
just going private, like fully private.
Yep. And that's what we do with almost all of our clients, is we evaluate, well, how much of your current income would you have if you went on your employer's long-term disability policy? And how does that compare to your expenses? And usually there's a huge gulf.
Yes.
And that's when we will recommend that they go spend, thousands of dollars a year, honestly, to get supplemental long-term disability coverage through a private insurance company. And yeah, it is expensive. And it is going to be the best money you ever spent if you become disabled.
Right.
And one of the things I always emphasize with clients is, if you're in your 20s and 30s, especially, basically the younger you are, your biggest asset is your ability to earn money. All disability insurance is protecting your ability to earn money.
Absolutely. Anything else to say on disability? I think we're good.
Nope. It's expensive, it's painful to pay, and it's oh so necessary for most of us.
It's the thing that people never want to pay. And even I will even say that because, this is mainly for the tech and biotech community that we run into, but we have a few physicians here being in San Diego, and they always want to fight in their heads, especially if they're 1099, having to pay. They're like, I want to pay how much to protect my disability? And I'm like, dude, how much did you spend getting this knowledge to use these hands that pay you hundreds of thousands of dollars, and you might not be able to use them.
Yeah.
You have to protect it, right? Even they don't want to do it, and they have highly skilled,
manual skills.
Manual skills, and then we're just talking about using brain power, but even then it's the same thing. Same thing. Yeah. Well, let's turn to 401k then. Because this is the time of year when we will definitely check in with an updated pay stub and see how far into the year are we and how much have you put away and are you going to hit your numbers? What are your thoughts there?
Yeah, well, this is the one employee benefit that doesn't have this sort of make a decision by X date or you're screwed deadline, right? Because every client I've ever worked with, I don't know if there's an exception to this, you can change your 401k contribution rate and your investments at any time during the year.
Yeah.
So there really isn't the same deadline pressure, but if your open enrollment is in the fall, as most employers are, it's a really good time, as you say. It's just a reminder to go in and look at how much you're contributing. Are you on track to get to the full $23,000 this year? Plus, if you're using after-tax 401k, are you on track to max that out, or at least max it out to the level you planned to? Right. Is the money being invested or languishing as cash? If it's invested, is it invested appropriately? So it's just a good reminder. Hey, I'm looking at all this other, oh my God, administrative BS that's really important to do. Might as well add this to the list and just make sure that everything's looking fine.
Agreed. We do the exact same thing. Another, it's like a little inside baseball for the average listener, but one of the other things we will always look at, especially if it's a newer employer for us, is we will look at the summary plan document for the 401k and see if they have a true-up provision. Mm-hmm. So a true-up provision for you guys at home, sometimes you might be beginning of the year, I just want to put the 23 grand in and be done. And I'll get my full match. So I'm great. And that's not the case always. It's dependent upon the rules of the plan. So it's not necessarily that they're going to match 3% of your salary based on you maxing out the 401k. It'll also be dependent upon the timeliness of when you put the money in.
You actually have to put the money in. You have to put the money in every paycheck in order to get the match sometimes.
Right, exactly. And a true-up provision is really designed, and I might be misspeaking on calling it a true-up provision, but the gist of it is that it basically says, you know what? You want to put your 23 grand in January, Meg, go for it. We'll make sure you get your full match at the end of the year. So if it has that, you're great. But if you don't have that and you're running it in, you might be missing out on thousands of dollars of match. So it's just something to be mindful of.
So there's basically one topic left, I think, that we actually need to make a decision on during open enrollment. And all the rest are things we just want you to be aware of. They're benefits that if you develop a need for them, we want you to know they're there. But accidental death and dismemberment is AD&D is the one choice you have to make to actually enroll in it and pay a premium or not. That both of us have had a lot of clients over the years asking whether they should or not. And it's scary as shit the way it's described. Well, God, yes, if I lose both eyes, I absolutely want to have an insurance payout. Oh my God. Or a leg and an arm. I tend to think that AD&D, you can be something called insurance poor, which is you are insuring against so many risks that you are just paying out so many premiums, and the likelihood that any of this is going to actually happen to you is vanishingly small. And AD&D sort of falls into that category for me because if you have adequate health insurance and adequate life insurance and adequate disability insurance, all of which we've just discussed what constitutes sort of adequate. If you have all of those are more or less going to cover all the risks that accidental death and dismemberment AD&D coverage also covers.
Yeah, no, I fully agree. I think for most people, they can typically go without it and be okay. I think that a person who might want to look at turning it on is someone who is underinsured on the life insurance side because they can't be in the private markets. It's another space where they may be able to flip this on and have a bit more coverage for their family. And it's not guaranteed, right? Because now there's specific rules for accidental death and dismemberment. There's kind of these specific rules at which you get the money, but it's better than nothing.
Right. And I've also recommended it before for clients who have had trouble getting disability insurance.
Yeah. Same idea, right? Same. Yeah. So it's just looking at like, well, what's the issue that you can't get proper insurance for the way you want it? Well, this might be a nice backup.
Yeah, this sort of gets you some extra money under some circumstances, whereas otherwise there's no way you can get coverage for the circumstances, the circumstance at all.
Yeah. Okay. So now we can go into like our lightning round of other stuff to consider during employee benefits time.
Yeah. And I think that the biggest dollar value benefit that you don't need to make a decision on, you just need to be aware that it exists. And honestly, most women I work with in the tech world are very aware that these benefits exist, but that's fertility benefits. Freezing your eggs, IVF, anything along the sort of fertility industrial complex.
Yeah, it's so amazing that it's a benefit that exists, especially for women growing careers, right? Because it's like, it's amazing that now we are at a place where like technology can make it so we can be like, I can choose to have children later if I want to.
Yeah, and I have
that benefit exists inside of corporate benefits is awesome.
Yeah, so I've had several clients take advantage of the egg freezing benefits. But again, this isn't something you have to elect or like pay for during open enrollment. It's just the opportunity to review the sort of laundry list of benefits available to you so that you know it's there.
That'd be like the meanest HR person ever. Are you going to have kids this year? No? Wait until next year.
Yes. Are you going to have fertility problems next year is the real question.
And I say that, I'm not saying it to be mean, like, or just, I am joking a little bit, but both of our young boys are fertility kids. So, but we got to pay it out of pocket. I wish that I worked at a tech company that had these benefits when I was going through that process.
My husband and I also partook of modern science when getting pregnant.
Super cool. I agree with that on that. Another is, and it's not necessarily that you have to elect either, but it does exist, and you'll see it in benefits, is charitable matching programs. So like if you guys are giving to charities that you care about, check and see if your company does a match, right? So we did this a few times with our little RIA firm, the old firm I worked at. We would do a little matching too. So I would always tell my boss, like, hey, I'm giving to so-and-so. And then they'd send the match. Well, you can do that with your company as well.
Yeah. Yep. Yeah. And I think a lot of the big tech companies have it. I'm thinking specifically of a client who works at Google, and it would just be a doubling match. Like you give $1, Google gives $1. And, if the whole point is to get money to the charity, I don't think there is a better deal out there than an instant doubling of your charity dollars.
Exactly. Okay. Two that come to mind that are finance related. And it's just it's something that we'll look at when we see that pay stub as well. We'll see how much have you been withholding in your RSUs this year, to see if you want to change the withholding amount of your RSUs. And what I mean by withholding is I'm saying the mandated amount is 22% federally, but often our clients are above the 22% bracket federally, right? So you can choose to go in and rather than have these big surprise tax bills or send in estimates every quarter, instead you just go in and go, you know what, I'm just going to dial up the withholding to 35% or 37% instead.
Yeah. Yeah, and again, this is not something that's usually strictly part of the same benefits enrollment process where you're choosing your health insurance, but it is sort of end of year type stuff that is going to end of year choices that will affect the next calendar year.
Right. Now, one that is usually tied to end of year, and it's tied to end of year once you've made it up through the echelons of management and you're kind of toward the C-suite side of things. We'll see deferred compensation plans get turned on. Deferred compensation plans, if you're not familiar with them, are basically you have your traditional 401k with compensation up to $330,000 is kind of the rule that we use for where we can put money in up to that dollar amount. And then once we cross that threshold, we can go into deferred compensation where we can say, hey, we can put more of our compensation away, but it has some very specific rules around it. But it's largely treated like a 401k with some very specific rules around money going in and money going out. And it's too complicated to explain now. So
we would need a whole episode at least.
Yes.
Yeah.
But typically the choice you have to make is either what percentage of my salary am I going to save in deferred comp, if anything at all, from 0 to up to a very high percentage. And then also usually for a bonus. 0 to a high percentage. And normally that choice for salary is made toward the end of the year. Sometimes bonus is made then as well, or bonus may be allowed to be made in like the June, July range. So you kind of get to stagger when you're choosing to defer cash flow, defer compensation, right? Because it's not an easy choice, but it is one that's an important choice.
Yep. Yeah. And that and the tax withholding on RSU income, again, just sort of those choices come sort of near the same time of the year. So maybe you're in your like personal finance mode and making decisions, but they're usually not part of that open enrollment deadline that,
right,
you get notified of
yeah,
in mid-October, and then it's, November 7th is the deadline for making all your choices.
Yes, deferred comp usually has a separate email with a separate deadline. But it's just, to your point, it's like you already have this hat on of thinking all things finance and employee benefits. So let's think about them all at the same time.
Yep. Yeah, and I think the last note I'd make is we went over the sort of the 4 most influential choices we think you have to make, and then we started in on a laundry list of sort of smaller benefits, maybe benefits that you don't even need to make decisions about. They're just there. Read your benefits booklet. There are, 1,000 benefits offered to you. Most of them will probably be useless, but for your specific situation, maybe there's one in there that is just going to be a perfect match. And you won't know it unless you look at the benefits booklet or like the umpteenth page on your, company's intranet. So just look through them all. You only have to make decisions about a short list of the benefits.
Yes. And that just reminded me that we didn't talk about ESPP, which again is not always employee benefit related. It's kind of like, here's the grant times that come up, but it's another one to think about cash flow wise. And that's like, get a gym membership, whatever. Like there's so many little tertiary benefits at the bottom that can be really helpful.
Absolutely. But don't freak out about them. Like if you don't read the entire 1,000-page PDF or website equivalent, if you get, the insurance choices correct or correct enough.
Insurance, 401k.
You're good.
Yeah.
You're good.
You're through 90% of it.
You've got the cake. You can just ignore the icing.
I like icing.
Yeah. True.
I was the kid who ate the icing and didn't eat.
Well, right. If our children were running the show, they'd be like, ignore the cake, man. Give me all the icing. But yes, for us mature adults.
That's right. All right. Well, let us, as far as, thank you for listening. And if you guys have questions, you're welcome to submit them at realpersonalfinance.co, because then we, have questions to answer, which is helpful. And if you like what you've heard, please leave a review where you listen, and we'll see you guys next time.
There you go. Thanks, Scott.